Today, we've got a topic that's absolutely crucial for anyone planning their retirement, the 4% rule. If you've never heard of it, you're in the right place. And if you have heard of it, stick around because we're going to dive deep into the details and strategies you need to know. The 4% rule is a widely discussed concept in the world of retirement planning, and it's become an essential guideline for anyone looking to secure their financial future. In this video, we'll explain what it is, why it's important, and how you can use it to make informed decisions about your retirement investments. Number 1. What is the 4% rule? The 4% rule, formulated by financial advisor William Bengen in the early 1990s, suggests that withdrawing 4% of your retirement savings annually should provide a high likelihood that your funds will last at least 30 years. This rule was based on historical market data and aimed to strike a balance between sustaining your lifestyle in retirement while not depleting your nest egg prematurely. To understand this rule, it's crucial to recognize its underlying principles. Bengen's study analyzed various retirement scenarios considering different asset allocations and historical market returns. His findings proposed that withdrawing 4% annually, adjusted for inflation, from a balanced investment portfolio, typically a mix of stocks and bonds, should sustain retirees through 3 decades. The 4% rule doesn't offer an absolute guarantee, but rather a probability based on historical market performance. It operates under assumptions that might not always align with future market conditions. Factors such as market volatility, unexpected expenses, and changes in longevity can influence its efficacy. The 4% rule serves as a guiding principle for retirement planning, offering a starting point for individuals mapping out their financial future. However, it's important to remember that it's not a one-size-fits-all solution. Adapting the rule to your specific circumstances and remaining flexible in your approach is crucial for a successful retirement strategy. Number 2. Factors affecting the 4% rule. Let's delve deeper into the critical factors that influence the application and effectiveness of the 4% rule. 1. Portfolio allocation. Your choice of investments significantly impacts the success of the 4% rule. A diversified portfolio, including stocks, bonds, real estate, and other assets, plays a vital role. Stocks historically offer higher returns but with greater volatility, while bonds provide stability but with comparatively lower returns. Finding the right balance suited to your risk tolerance and time horizon is key. A crucial consideration is how market performance affects your portfolio's value, especially during the early years of retirement. A market downturn can significantly impact the sustainability of your withdrawals. Therefore, diversification and periodic portfolio rebalancing become essential strategies to navigate market fluctuations. 2. Inflation. Factoring in the eroding power of inflation is crucial for the longevity of your retirement savings. While the 4% rule suggests a fixed withdrawal rate, the real purchasing power of that amount decreases over time due to inflation. Therefore, incorporating inflation adjustments into your withdrawal strategy is essential for maintaining your lifestyle throughout retirement. To ensure your withdrawals keep pace with inflation, periodic adjustments aligned with the Consumer Price Index or other inflation metrics are necessary. This practice enables your income to maintain its real value over the years. 3. Life expectancy. The estimated duration of your retirement plays a crucial role in determining the sustainability of your withdrawal rate. If you expect a longer retirement, a lower withdrawal rate might be necessary to ensure your funds last. Longevity risk, the possibility of outliving your savings, can be mitigated by considering factors like health, family history, and lifestyle. It's vital to reassess and adjust your financial plans based on changes in life expectancy and health conditions. Understanding these pivotal factors and how they interplay with the 4% rule is essential for crafting a robust retirement plan. Number 3. Strategies for maximizing the 4% rule. Implementing the 4% rule effectively involves employing strategic approaches tailored to your individual financial goals and circumstances. Here are essential strategies to optimize the rule for a more secure retirement. 1. Diversification. A cornerstone of successful investing is diversifying your portfolio across various asset classes. Spread your investments among stocks, bonds, real estate, and other assets to reduce risk exposure. Diversification can cushion your portfolio against the volatility of any single asset class and potentially enhance long-term returns while maintaining stability. When diversifying, consider your risk tolerance, time horizon, and financial objectives. For instance, younger investors might lean towards more aggressive allocations, while those closer to retirement might prefer a more conservative mix. 2. Regular monitoring. Constant vigilance over your investment portfolio is crucial. Keep a close eye on market trends, your portfolio's performance, and any changes in your financial situation. Periodic reviews and adjustments ensure your investments remain aligned with your goals. Rebalancing your portfolio periodically, perhaps annually, helps realign your investments with your intended asset allocation. For instance, after a bullish market phase, it might be time to readjust your portfolio to maintain your risk-return balance. 3. Flexibility. Markets are inherently unpredictable, and financial needs can change over time. Being adaptable and open to adjusting your withdrawal rate based on market conditions and personal financial requirements is essential. Remaining flexible allows for maneuverability in times of market turbulence or unexpected expenses. During times of market volatility, being willing to slightly adjust your withdrawal rate can help preserve your savings for the long term. Implementing these strategic approaches alongside the 4% rule can bolster your financial preparedness for retirement, offering resilience against market fluctuations and financial uncertainties. Number 4. The 4% rule in action. Real-life case study. Now, let's examine a real-life case that illustrates the application of the 4% rule in a retiree's financial journey. Meet Sarah, a retiree who diligently planned her retirement using the 4% rule. At the age of 65, Sarah had accumulated a retirement portfolio of $1,000 after years of consistent savings and prudent investing. Implementing the 4% rule, Sarah calculated an initial annual withdrawal of $40,000, adjusted for inflation annually. Sarah's portfolio consisted of a balanced mix of stocks and bonds, allowing her to benefit from market growth while maintaining a level of stability. She kept a close eye on her investments, periodically rebalancing her portfolio to align with her risk tolerance and financial objectives. As Sarah advanced in her retirement journey, she encountered market fluctuations, including a few downturns that affected her portfolio value. However, due to her diversified investment strategy and periodic adjustments, Sarah's portfolio weathered these storms, allowing her to maintain her planned lifestyle without significantly depleting her savings. Sarah's adaptable approach also involved some flexibility in her withdrawal strategy. During more challenging market conditions, she slightly adjusted her annual withdrawal rate, ensuring the longevity of her funds. By diligently adhering to the principles of the 4% rule, diversifying her portfolio, regularly monitoring her investments, and embracing flexibility, Sarah managed to enjoy a fulfilling retirement while sustaining her financial security. Her success is a prime example of how the 4% rule, when combined with strategic financial planning, can offer a reliable framework for a comfortable retirement. Number 5, call to action. The 4% rule stands as a powerful guideline in the realm of retirement planning, offering a structured approach to managing your nest egg during your golden years. However, it's important to acknowledge that this rule isn't a universal remedy for every retiree. Tailoring it to your individual financial circumstances and aspirations is paramount. Understanding the nuances of the 4% rule, along with the factors and strategies that influence its application, provides a robust foundation for a secure retirement. Incorporating elements like portfolio diversification, inflation-adjusted withdrawals, and adaptable strategies ensures greater resilience against market volatility and financial uncertainties. Continually reassessing and adjusting your retirement plan as life circumstances evolve is key. Regular reviews, staying informed about market trends, and making necessary adaptations to your financial strategy are crucial components for long-term financial security. To maximize the effectiveness of the 4% rule, I encourage you to consult with financial advisors or retirement planning experts. They can provide personalized guidance and help tailor this rule to suit your specific needs and objectives. Don't forget to continue educating yourself on investment strategies, retirement planning, and financial literacy, and always stay open to learning more about ways to secure your financial future.